Welcome to the Rational Edge. Today we're doing a deep dive into something massive, but almost entirely invisible. We're exploring the assets that are really driving the 21st century economy and why valuing these huge global AI companies requires a complete paradigm shift. We have to move past judging value based on things you can actually touch.
It really is a complete reversal. I mean, to get a handle on the modern economy, you have to just stop valuing things based on what you can count or see.
Like factories or inventory.
Exactly, like factories or supply chains. Our mission today is to really unpack where that scalable, that exponential revenue comes from. And it's from intangible assets, it's proprietary data, software, and of course, the legal frameworks that protect all of it.
Okay, let's break this down. I think the best way to show the scale of this shift is with a really stark contrast. Let's start with a classic industrial giant, Ford Motor Company. As of early 2026, its market cap was sitting at around, $53 billion? Ford is the definition of a tangible blue-chip company.
Absolutely, and just think about the sheer physical substance behind that number. You're talking hundreds of thousands of employees, these massive global assembly plants, millions of tons of steel.
And cars sitting on lots all over the world.
Right. It's wealth built on a colossal material footprint. You can see it. You can touch it.
Now you compare that to what we could call a ghost company, OpenAI. Its physical footprint is almost nothing. A few offices, some server farms, data centers. But its expected IPO valuation for 2026 is just staggering, somewhere between $800 billion and $1 trillion.
And that comparison right there, that's the core metaphor for this new economy. It should really stop you in your tracks.
A company with almost no physical plant is being valued at 15, maybe 20 times higher than a company that makes millions of actual cars.
It's a huge difference. And it tells you that the old asset-heavy valuation models are, well, they're functionally obsolete when you're looking at pure intelligence companies.
I see the colossal difference. But help me understand, if we're talking a $1 trillion valuation with minimal physical assets, what is the asset? If it's not steel, what's the new crown jewel here?
Okay, so to get that, we have to draw a clear line between asset appraisal and business valuation.
Okay.
Appraisal is just, what's this one machine worth? But valuation looks at the whole company as a going concern. It includes the tangible stuff, sure, but more importantly, it includes all those invisible assets.
So for an AI company, what's the one thing with that single most expensive invisible asset? What is the $800 billion ghost?
It's the model weights. These are the billions, sometimes trillions of numerical parameters that define how a model like GPT-5 actually works.
Guy learns how it produces results.
Exactly. You can think of the model weights as the AI's compiled brain. You can't touch them. They're just digital files, but they are the single most valuable asset on the balance sheet.
I'm still trying to wrap my head around a multi-billion-dollar asset that is, in essence, just a giant digital file. How does that become more valuable than Ford's entire assembly line, which makes real cars people drive?
The value comes from two things: the immense barriers to entry and the catastrophic sunk costs they represent.
Sunk costs.
Yeah. Building model weights isn't just about coding. It's a continuous, massive R&D commitment that's almost impossible for anyone else to reproduce.
So tell me more about that cost. How is that different from, say, traditional capital expenditure?
Well, building a huge factory might cost $5 billion, but once it's built, the spending kind of stabilizes.
And it generates revenue.
Right. But creating a frontier AI model involves costs that just keep escalating.
Yeah.
First, there's the cost of getting and, curating rare proprietary data. And second, the big one is the massive sustained investment in GPU compute time.
So it's not like buying a machine you can sell later.
Not at all. It's capital that is sunk. It's non-recoverable R&D. We're talking billions of dollars and billions of hours of compute time. That cost itself becomes the moat.
And this huge structural shift, this great reversal, this has been building for a long time.
Oh, yeah. It's a generational shift. If you go back to 1975, tangible assets, land, factories, machines, they accounted for something like 83% of the S&P 500's market value.
And the power players were Exxon, GE, IBM.
Industrial behemoths. But by 2020, that number had completely flipped. Intangible assets made up over 90% of the S&P 500's value. And the leaders are now these pure tech ecosystems: Apple, Alphabet, Microsoft.
And their value is from software, data, and now these model weights.
Right. It's a world where the intellectual core is what holds the value, And the massive physical spending on data centers is just the price of admission to maintain that edge.
Which brings us to the logical next question for any investor. If these model weights are the new source of wealth, how do you defend that invisible moat?
And that's where the intellectual property legal defense system becomes absolutely critical.
It's the legal architecture of the whole thing.
It is. We can group the defenses into four main pillars: patents, trademarks, copyrights, and trade secrets. And the real genius is how you strategically deploy them.
Okay, let's start with trade secrets. This is what people call perpetual protection. What does a company actually have to do to maintain one?
It's a tough three-part standard. First, secrecy. It can't be generally known. Second, it has to get its economic value from being secret. And third, and this is where a lot of companies trip up, you have to prove you took reasonable efforts to keep it secret. NDAs, secure systems, all of that.
It sounds risky, though, keeping something so valuable a secret. Why wouldn't a company just patent its core AI system and get the strongest possible legal protection?
That is the core strategic dilemma for every modern tech company. A patent gives you a powerful 20-year period of exclusivity, but it comes at a price.
Full public disclosure.
Full public disclosure. You have to lay out all the technical details of your invention for the world to see.
And in a field moving as fast as AI, what happens after those 20 years are up?
The minute that patent expires, your core logic, your secret sauce, it immediately enters the public domain. Your competitors can legally copy your foundational structure. For AI, where innovation cycles are measured in months, 20 years is basically an eternity.
So a company would essentially be gifting its future success to its rivals.
Exactly. That's why the big players use a very complex mixed strategy. They might patent non-core stuff, things that could be reverse engineered, but the core logic, the dynamic model weights that they protect as a perpetual trade secret.
They're trading certainty for the potential of infinite protection.
It's a calculated risk.
Okay, shifting gears a bit, how do they protect their brand? The connection with the customer, that's where trademarks come in, right?
Correct. Trademarks are all about identifying the source of a service and protecting the overall consumer impression so people don't get confused.
And it's not just the name.
Not at all. The Lovell versus Volvo case was really instructive on this.
Walk us through that one.
So the Chinese company Lovell had its trademark revoked. The court didn't just look at the name sounding similar, they looked at the font, the color scheme, the whole arrangement. Trademark law protects that total impression, that gestalt, to make sure the public isn't being misled.
Okay, so this brings us to what feels like the most contested legal battlefield for AI today: copyright. Specifically, this thing called the idea-expression dichotomy. Why is that so important?
This is absolutely fundamental to justifying how AI models are trained. Copyright protects the specific expression, the actual words on a page, the specific lines in a drawing, the exact code.
But not the idea behind it.
Critically, no. It does not protect the underlying idea or facts or the functional structure.
And this concept has been around for a while.
A long while. The classic case is from 1982, Atari versus North American Philips. It was about Pac-Man and an imitator called CD Man.
Right.
The court ruled that the basic game mechanic, a character running around a maze eating dots, that was an unprotected idea. Anyone could use it. Only Pac-Man's specific, unique look was the protected expression.
So applying that to today, when an AI model trains on public data, the legal argument is that it's absorbing the idea of a style or a fact, not copying the specific protected expression.
That's the argument in a nutshell. The model learns the concept of how to create art, not that it's just replicating one specific piece of art. The entire industry's valuation hangs on how courts eventually interpret substantial similarity between AI output and the original copyrighted data. It's a huge legal risk.
Which must make valuing these ghost companies incredibly difficult. If they're so unique and legally sensitive, how do you even put a price on them? Traditional methods must just fail.
They largely do. The cost approaches, while it's useless, it only tells you what you spent to build the asset, not what it's going to earn.
And the market approach.
Also very limited, because these models are unique. You don't have comparable public assets to benchmark against, so it becomes very subjective.
So what's the gold standard? How do analysts figure out the future value?
It all comes down to the income approach. This method calculates the present value of all the future economic benefits the asset will generate.
And it centers on something called the efficiency premium.
The efficiency premium, that's the key.
Give us a clear, practical example of that.
Okay. Let's say a company performs a task manually and makes $1 million in profit. If they switch to using a new AI asset to do the same task, and the profit jumps to $1.5 million.
That extra $500,000.
That $500,000 difference is the value, the premium, created only by that AI asset. That premium is then projected out over time and capitalized into the final valuation.
And we're seeing this play out in the public markets, right? It's not just theory. Look at NVIDIA.
NVIDIA is the perfect evidence. Over the last 5 years, their stock price grew about 14 times, but their underlying earnings grew an even more dramatic 20 times. It shows the valuation is being supported by real, fundamental earnings growth.
But here's where it gets interesting. Despite these huge earnings-backed valuations, you've said these ghost companies are incredibly fragile. You mentioned a geopolitical risk tax. Why so fragile?
Because their entire value is tied to future cash flow. And unlike a physical factory, that cash flow is extremely sensitive to sudden policy shifts.
The factory won't just disappear because a new law is passed.
Exactly. Its asset base is secure. But an AI model's value is tied to intellectual property. Imagine if Congress passed a strict copyright law that restricted using public data for training.
The value of OpenAI's core asset could drop overnight.
It could drop in half, instantly. Or think about a sudden change in export controls on advanced chips. This vulnerability demands a much higher discount rate, that risk tax, because the asset's value depends on a vote in Washington as much as it does on consumer demand.
Speaking of huge valuations, 2026 is shaping up to be the year of the Mega IPO. We're seeing this incredible concentration of private value about to hit the public markets.
It's an unprecedented convergence. You've got SpaceX targeting $1.5 trillion, OpenAI aiming for up to $1 trillion, and Anthropic maybe $350 billion. That's a potential injection of nearly $3 trillion in liquidity.
And that concentration always brings up the bubble question. Is this just another dot-com scenario?
Well, if you apply the rigorous financial framework for what a bubble is, the answer right now is pretty counterintuitive.
How so?
The classic signs of a bubble-like massive excess capacity speculative credit, companies with no revenue, they're just largely absent in the top AI leaders today.
But that sheer pace, that $3 trillion in liquidity, that must be a sign of some market fever.
It signals exuberance for sure, but the investment is being driven by realized earnings growth. Look at the numbers. Over the last 3 years, public AI companies have seen their earnings per share estimates more than double, but their forward price to earnings multiples have actually declined.
So the profits are justifying the valuations.
For now, yes. It means the investment is backed by concrete cash flow. The risk isn't an immediate crash, but maybe future overexuberance down the line as more speculative players jump in.
So wrapping this up, what does this all mean for you, the investor, or just the curious observer? We've seen a total reversal of the economic paradigm since 1975. Modern wealth is now defined by the quality and the defensibility of these invisible assets.
And the investor's job has fundamentally changed. You now have to be just as attuned to shifts in copyright law or export controls as you are to traditional financial metrics like EBITDA. Those legal and policy shifts are now primary drivers of value.
So if this technological transformation is real, the ultimate challenge for investors isn't really the risk of a bubble bursting.
No, the much greater risk is completely missing out on this fundamental structural shift in how value is created on a global scale.
It demands a new way of seeing the economy, where the moat is no longer built of steel, but of knowledge and law. Thank you for listening. See you next time.